Today we are not just skimming the surface. We're really preparing for a serious plunge into one of the most, well, dynamic and complex sectors out there, Turkish capital markets.
That's right.
And our focus today is Gedik Yatırım Menkul Değerler Ash, along with its whole group of subsidiaries.
Exactly. And for you, the listener, the curious investor, our mission today is to really make sense of these consolidated financial statements and the activity report. We're looking at the first 9 months of 2025, ending September 30th.
Yeah, this stuff is dense.
It is. It's dense reading. It covers everything, from their core brokerage business right through to venture capital, even crypto assets now.
And crucially, we're tackling this using inflation-adjusted figures. This is mandatory under TMS 29 reporting standards in Turkey. And it's not just technical jargon, right? This is really the key context.
Absolutely. These aren't just nominal figures that look big because of inflation. They're supposed to be real inflation-adjusted numbers reflecting the actual purchasing power of their earnings.
Yeah.
Think of it this way. Trying to analyze financials in a really high inflation environment without adjusting. It's like trying to measure a football pitch with a rubber ruler that shrinks every single day.
Right, the numbers look fine, but the actual distance is changing constantly.
Precisely. So TMS 29 is the attempt to kind of standardize that rubber ruler. And our goal here is to translate these complex adjusted figures into clear, actionable insights for you. We want to help you separate, genuine operational health from just volatile financial gains or market noise.
Absolutely. We really want to get to the bottom of it. Is Gedik succeeding because its core brokerage engine is like firing on all cylinders? Or is it more that they're mastering the financial markets and, frankly, the accounting rules within this very challenging macro environment?
That distinction is everything for a long-term investor.
It really is.
And we start with this monumental paradox. Gedik Yatırım reported this massive record-high revenue number for the 9 months. It's a jaw-dropping surge.
Huge numbers.
Huge. Yet at the very same time, their core operating profitability actually dipped significantly.
Okay, so high revenue, lower core profit.
But wait, there's more. Despite that, their final net period profit shot up nearly 400%.
Wow, okay.
That disconnect, that's the central mystery we need to solve today. And it really speaks volumes about the current state of Turkish finance, I think.
Definitely. Now, before we fully dive in and open the books, just a quick reminder, if you find this level of detail valuable, if you want us to keep peeling back the layers on reports like this, please do give us a follow, subscribe, perhaps share this deep dive.
Yeah, lets us know these conversations are hitting the mark and providing real value.
Exactly. Okay, let's get started. #Tech2 group organization and business overview. All right, let's establish who we're dealing with here. Gedik Yatırım Menkul Değerler Ash, founded back in 1991. So they're a seasoned player, a veteran in the Turkish capital markets.
Definitely. And their classification is key. They're a Danish Yetkili Araka Kurum,
Which translates to?
a broadly authorized brokerage house. That designation is basically their license to operate across almost the entire capital market spectrum. It really distinguishes them from smaller, more niche players.
So they can do pretty much everything.
Pretty much. Their scope is vast. They handle trading activities across all sorts of assets. They manage portfolios, individual ones, general funds. They offer investment consulting, which is crucial. They underwrite public offerings, IPOs, SPOs, which has been a huge potential revenue source lately. And they provide limited custody services, too. They're positioned as a full-service financial intermediary.
Okay, and that broad scope, it naturally requires broad reach, right? This source material details a pretty extensive domestic network. The HQ, the Merkez, is in Istanbul, Maltepe specifically, but their physical footprint, it seems genuinely national.
It is. They're spanning from Adana and Kayseri down south and central all the way up to Trabzon on the Black Sea coast, and numerous places in between Ankara, Antalya, Bursa. The list goes on.
And this geographic spread, it's not just about chasing market share, is it?
No, I don't think so. It's about capturing localized capital, understanding regional business dynamics. It signals a real dedication to serving those secondary markets, which often have, high growth potential and maybe less intense competition than just Istanbul or Ankara.
Good building relationships across the country.
Exactly. Cultivating them deeply. But the real insight into their strategy, I think, the part that signals a focus perhaps more on quality over just sheer volume, comes from those specialized private offices they list.
Right. Akdeniz Private, Bostak Kadesi Private, Boskent Private in Ankara, Edler Yeşilköy.
That's like a neon sign flashing high net worth client focus. These aren't your typical walk-in retail branches.
No.
They're offering bespoke, tailored services. Think estate planning, complex tax structures, highly customized portfolio management. You need a certain asset level to even walk in the door, typically.
So what does that strategic choice, focusing on these private clients, imply about how they see themselves in the market?
Well, it implies a clear strategy to diversify their revenue streams, moving away from just the volatile, often low-margin retail trading commissions and towards more stable, recurring fee income that you get from wealth management.
So they're competing more with private banks now.
Exactly. Private banking arms of the big banks and also those top-tier independent wealth managers. These high net worth clients tend to be stickier, their accounts often generate better margins, and that's crucial, especially in an environment where basic equity commissions are just being squeezed across the entire industry.
Makes sense. And we also see their footprint extended through their subsidiary, Marbosch Menkel Delerle Lache. That adds another main center, 12 branches, and 3 liaison offices to the group's total count.
Right, so the combined physical presence is really quite significant. The consolidation of Marbosch ensures the group maintains that competitive physical advantage, even while the whole industry is pivoting heavily towards digital channels.
So it's a hybrid model.
Seems like it. Designed to capture both the traditional relationship-based client and the digitally savvy online trader.
Okay, now let's look at the people, the operational headcount. It actually decreased slightly, from 721 employees at the end of 2024 down to 686 by September 2025.
Right, that's about a 5% drop. But, and this is a big but, we see later in the report that their personnel costs absolutely soared during the same period.
Okay, so fewer people, but costing much more.
Exactly, which creates this immediate paradox when you think about operational efficiency. Normally, a decrease in headcount in finance might suggest, successful automation, streamlining processes, maybe replacing some roles with tech,
Those
or,
things are tough, and they had to make cuts.
or a difficult operating environment leading to layoffs, yes. But given the simultaneous major increase in personnel expenses, the most likely explanation here is a sharp increase in the cost per employee.
So either they're shedding lower skilled roles, maybe due to that automation, and keeping the high skilled, very expensive experts.
That's one possibility.
Or the inflationary pressure on salaries is just so immense that even cutting 5% of the staff couldn't offset the necessary pay rises for the remaining 95%.
I suspect the latter is the dominant force here, maybe coupled with a strategic focus on retaining that highly specialized talent they need for the sophisticated stuff, the underwriting, the high net worth consulting.
It really highlights that brutal inflationary struggle facing all Turkish service companies, doesn't it? You try to achieve efficiency through tech, but then inflation just gobbles up any savings on the labor cost side.
It's a treadmill, running hard just to stay in place, financially speaking, for many. Hashtag Tech 3, corporate structure, governance, and diversification strategy. Okay, moving beyond just the day-to-day operations, let's look at the corporate DNA, the structure. Gedik Yatırım is controlled by Inveo Yatırım Holding Eş.
Right, they hold just over half, 50.85%.
And the rest, 49.15%, floats on the Borsa Istanbul, the stock exchange.
So this controlling stake by Inveo means that the diversification strategy, the growth path we're seeing at Gedik, it really has to be viewed through the lens of what the larger holding company, Inveo, wants to achieve in its ecosystem.
Absolutely. And their strategy, judging by the subsidiaries they've set up or invested in, is anything but conservative. It looks quite aggressive, actually.
How so? What are the key pieces?
Well, you can see their strategic direction outlined by these core entities. First, you've got GYT Bilişim and Fanchain Technology. These are clearly focused on financial technology, fintech, and innovation.
Okay, tech focus.
Second, Marbosch Menkel Değerler Aş, which we mentioned that's their traditional brokerage expansion arm, extending their reach.
Right.
Third, Yatırım Yatırım, holding Ashu. This seems to be a vehicle specifically for making strategic investments.
Like an investment arm within the investment firm.
Sort of, yeah. And fourth, Türpe Girişim Sermayesi Yatırım, or Taklu Ash, or Tupe GSYL. This is their direct play in the venture capital world.
Okay, so iChain and Turpe really show that appetite for maybe higher risk, higher growth assets. And we saw some activity there, right? The stake in Turpe GSY was reduced.
Yes, exactly. It went down from 88.2% to 55.79% following a capital increase at Turpe.
What does that tell us?
That capital action is significant. It suggests they brought in external minority investors to help fund the growth of the venture capital portfolio itself. So they're sharing the risk, sharing the burden of funding the capital calls for the underlying startups within Turpe's portfolio, but they still retain effective control with that 55.79% stake.
Smart move. Scaling exposure without soaking up all their own internal cash.
Especially critical given the cash flow pressures we're going to discuss later. It's a prudent way to manage that kind of expansion.
Okay, that brings us nicely to their longer-term strategic investments. These are like their big bets on the future of finance, right? The stake in Mission Yatırım Bankası AŞ stands out 20%.
It's a massive piece of strategic positioning, absolutely. Even though it's slightly reduced from 23% after the bank itself did a capital increase, that 20% stake signals a clear intent to integrate brokerage services with more traditional investment banking activities.
Synergies.
Potential synergies, yes. Think corporate finance advisory, M&A deals, underwriting major bond issues or equity offerings. These could offer stability and potentially higher margin opportunities that purely transactional commissions maybe can't match consistently.
Makes sense. And then there's the really headline-grabbing move, acquiring a 66.67% stake in Mission Crypto Varlık Alım Satım Platformu SG.
Done through that e-chain Yatırım holding vehicle we mentioned.
This is them planting a flag directly in the digital asset space, the crypto exchange.
Well, it's more than just planting a flag, I'd argue.
Right.
This looks like a calculated, pretty aggressive move to get ahead of the regulatory curve. We know Turkey is moving towards clearer regulation for crypto assets.
Right, it's been discussed for a while.
So by acquiring a majority stake in a platform now, they're positioning themselves to potentially be a key regulated financial service provider in a market that has shown absolutely explosive retail interest over the past few years.
Huge potential upside.
Huge potential upside. But also, let's be clear, an enormous risk. The crypto market is notoriously volatile.
And it ties up substantial capital in that volatile sector, too. We also see some other interesting holdings listed. Novel Scala Publishing, Aposto Technology, Hop Technology, Detay Danışmanlık. What's the connection for a brokerage with media and tech like these?
It seems they view themselves not just as money managers, but maybe as information providers and technology integrators as well. Aposto and Novel Scala are essentially media and content platforms. Hop Technology is involved in mobility solutions, I believe.
Huh.
It confirms this kind of holistic view they seem to be taking. They want to be present wherever their clients are consuming information, managing transactions, maybe even moving around. They're investing in the broader financial ecosystem, not just the trading terminal itself.
Interesting. Okay, let's pivot slightly to governance and compensation. The sources show short-term benefits paid to senior management. What were the numbers?
Totaled 103.8 million Turkish lira for the first 9 months of 2025.
Okay, and that's notable because...
Particularly because it represents a decrease. In the same period in 2024, the figure was 137.7 million TL, so a drop of about 25%.
It's interesting. In a high inflation environment and with high net profit, management pay went down.
Yeah, it's an interesting trend reversal. We don't have the full breakdown of, say, performance bonuses versus fixed salaries in this summary, but a 25% drop in those short-term benefits. It could suggest a change in the management team structure, maybe fewer senior execs overall, or perhaps that some key performance indicators tied to those bonuses weren't fully met.
Like maybe the core operating profit targets we're about to discuss.
That would be a logical connection, yes. If bonuses were tied to core operational health, that decline might explain the drop in compensation, despite the high net profit driven by other factors.
Got it. And one necessary point on transparency, or perhaps the lack of it here. The financial report provided didn't give details on the number or ratio of female board members or senior managers.
Correct. That data point wasn't included in the materials we reviewed. While it's not legally mandatory everywhere, it is becoming a standard disclosure that institutional investors, especially those focused on ESG and diversity metrics, increasingly look for.
Something to know. Okay, let's get into the financials.
All right, now we delve into the core financial numbers. This is where that paradox really starts to emerge. Let's start right at the top line, the sheer volume of activity, the hasılat, or total revenue.
And the scale of the increase here is just, well, it's eye-watering. It jumped from 72.5 billion lira in the first 9 months of 2024 to a monumental 272.7 billion lira in the same period in 2025. That's almost a 300% increase, even in these inflation-adjusted terms.
It's staggering, and this is where we have to stop and ask the crucial question. Did Gedik Yatırım suddenly start managing 4 times the assets? Did they quadruple their client base? Or do they engage in one specific type of activity at a absolutely massive scale?
And the breakdown shows it's the latter, right?
Very much the latter. And it fundamentally changes how we should view their growth. The primary driver, overwhelmingly, is a monumental rise in government bond sales. Devlet Tavaliri.
Right. That specific line item exploded from just 200.4 million lira in 2024
Peanuts, relatively speaking.
to 216.9 billion lira in 2025. Almost all of the revenue increase came from just that one activity.
Precisely. And this tells us two really important things about the operating environment they're in. First, the Turkish fixed income market is clearly experiencing tremendous volatility and volume, probably driven by aggressive interest rate hikes by the central bank and the need for large institutions, maybe sovereign funds, to actively manage their bond portfolios in response.
Okay, high activity in the bond market.
Second, Gedik is right in the middle of it, facilitating these huge, high-volume transactions. Now, whether that's mainly as an agent for big institutional clients or through their own proprietary treasury trading desk, or probably a combination of both, they are moving enormous amounts of government debt.
Okay, but this leads us directly to that margin squeeze you mentioned earlier. If revenue jumped by 200 billion lira, you'd normally expect gross profit brut car to follow suit. Maybe not by the same percentage, but significantly up.
You would.
Yet their gross profit actually decreased. It went from 3.19 billion lira down to 2.92 billion lira. How does that even happen?
Margin compression. So severe, it basically swallowed that entire 200 billion lira revenue surge whole and then some.
Wow.
Look at the cost of sales number. It was 269.7 billion lira. That's just 3 billion lira shy of the total 272.7 billion lira revenue figure.
So almost zero gross margin on that bond trading activity.
Extremely thin margin. This confirms that the government bond sales, while impressive in volume, are an incredibly high volume, incredibly low margin business, great for, top-line bragging rights, maybe market presence, but they contribute minimal quality profit to bottom line after costs.
Okay, so if that massive fixed income activity is essentially netting close to zero profit after the direct cost of sales, where do we look for the true performance of their core business? The traditional brokerage services, the wealth management fees, the stuff that's supposed to be their bread and butter.
We have to look further down the income statement. At the core operating profit, İsas Faaliyet Kuru. This is really the gold standard for assessing the health of a service business like Gedik, because it strips away all the noise from treasury trading, financial gains from investments, and those accounting adjustments.
So this tells us how efficiently the actual commission-generating, service-providing machine is running.
Exactly. Independent of market speculation or accounting rules. And that core operating profit, it declined significantly.
What were the numbers again?
It dropped from 1.50 billion lira in 9M 2024 to 1.16 billion lira in 9M 2025.
Okay, so that's the number that reflects the pressure on the core business.
That drop is the clearest evidence, I think. It
Yeah.
confirms our earlier hypothesis. The explosion in top-line revenue really masked a genuine slowdown, or at least increasing difficulty, in actually monetizing their fundamental brokerage and service activities. That decline is a critical red flag for any investor looking for long-term operational sustainability.
Okay, understood. Now for the grand puzzle. If core operations declined and gross profit actually fell, how on earth did the net period profit Denim Net Korean manage to shoot up so dramatically? From 306.7 million lira to 1.22 billion lira. That's that 400% surge we flagged at the start. Where did that profit come from?
Right, we have to unpack that delta. And it's driven entirely by items below the core operating profit line. Non-core factors. There are basically three powerful levers at play here.
Okay, lever number one.
Financial income. Finansman Çilerleri.
How much did that change?
It more than doubled. Rose from 446.2 million lira to 1.06 billion lira.
Wow. And why would that be?
In a high-interest rate environment like Turkey's, this income stream thrives. It comes from interest earned on their cash balances, maybe short-term investments, money market operations. This isn't just luck. It's about being optimally positioned to benefit from high central bank rates. It suggests they're pretty adept at treasury management in this kind of high-rate world.
Okay, so financial income was a big boost. Lever two.
Gains from securities valuation.
Yeah.
Menkul Kıymet Değerleme Çilerleri.
How did that do?
Also a massive jump, from 610 million lira up to 1.32 billion lira. This profit reflects the, effective management of their investment portfolio. It probably benefited both from the general buoyancy we saw in the Borsa Istanbul during parts of that period, and maybe some targeted profitable equity or debt positions they held.
These are mark-to-market gains, though, right? Not cash realized necessarily.
Mostly, yes. And while they are real gains on paper, they are inherently more volatile than steady commission income. A market downturn could reverse these just as quickly.
Okay, financial income up, investment gains up. What's lever number 3? You mentioned something technical.
Yes, the most technical but arguably the most powerful impact on the change in net profit this period. The reduced monetary loss due to inflation accounting under TMS 29.
Right, the net parasoldo in posición KB.
Correct. This net monetary loss, which reflects how much the company's monetary assets lost purchasing power compared to its monetary liabilities due to inflation, it shrank significantly year over year.
How much?
In 9M 2024, the inflation adjustment resulted in a massive loss of 1.19 billion lira, a huge drag on reported profits. But in 9M 2025, that calculated loss was only 573.3 million lira.
Still a loss, but much smaller.
Much smaller. So simply being less penalized by the inflation adjustment process this year compared to last year meant an immediate boost of over 600 million lira to the bottom line, just from that accounting standard change relative to the prior period.
Wow. So the inflation adjustment itself, while still showing a loss of purchasing power, was just less detrimental this time around. It essentially delivered an accounting tailwind that helped paper over some of the operational pressure.
That is the ultimate conclusion for you, the investor, looking at this. The massive 1.22 billion lira net profit. It's real in an accounting sense, but its quality is questionable. Because it's heavily reliant on that financial income spike, on potentially volatile investment portfolio performance, and on those favorable but potentially unpredictable inflation accounting dynamics. It is not driven by sustained strength or improvement in the core brokerage commission business.
Which makes the reported profitability higher risk and maybe less predictable going forward.
Exactly. You need to understand where the profit is truly coming from. #TAG-V. Detailed operational and cost analysis.
Okay, so to really confirm that pressure on the core business, let's zoom in a bit more on the operational breakdown, starting with the real bread and butter, brokerage commission income. Article commission gellerlery.
Yes, this metric tells the story perhaps most clearly. Commission income declined sharply. It went from 1.05 billion lira YTD 2024 down to 700.6 million lira YTD 2025.
That's a drop of nearly a third.
Wow, it is significant.
And in an environment where we know overall market activity, especially that bond trading, was incredibly high, seeing core commission income fall like that, what does it suggest? Intense fee compression, price wars.
I think it's likely a combination of factors. Intense fee compression across the industry is definitely happening, especially for standard equity trades. Aggressive price wars are probably part of it. It might also suggest that their strategic push towards high net worth clients, while maybe promising for the future, hasn't yet fully offset the decline in revenue for more traditional, maybe retail-focused volume commissions.
And the high inflation environment probably makes each lira of commission worth less in real terms, too.
Absolutely. Brokerages are under massive pressure to cut trading costs, to attract and retain customers, especially in the digital space where switching is easy. And the fact that commission rebates to customers Comisión Adelaire actually decreased slightly from 25.2 million TL down to 16.1 million TL, well, that clearly wasn't enough to mitigate the overall drop in gross commissions earned.
Okay, let's circle back now to expenses. General and administrative expenses, General they increased significantly, didn't they?
They did. Rose to 2.003 billion lira, up from 1.715 billion lira in the prior year period. And this rising cost base directly feeds into that squeeze we saw on the core operating profit.
Right. And the biggest chunk of that G&A cost was?
Personnel expenses. Easily the single largest contributing factor here. It increased from 975.6 million lira to 1.236 billion lira.
That's a jump of nearly 27%.
It is. And this is where we really have to challenge that simple efficiency narrative again.
Because personnel costs soared 27% despite them cutting staff numbers by 5%.
Exactly. It really suggests that any savings from technological automation or process streamlining, if they happened, were completely overwhelmed by the inflationary wage pressures.
They're running hard just to stay in place on costs.
It seems that way. They might have made strategic cuts in headcount, perhaps in certain areas, but the mandatory, or at least market-driven, salary increases needed just to retain talent in Turkey's high inflation economy seem to have completely devoured any potential operational savings from having fewer people.
It's a common macroeconomic burden for service companies right now, but it directly undermines their ability to grow those core operating margins, doesn't it?
It really does. However, it's important to note that not all the expense increases look purely defensive or inflation-driven. We do see signs of deliberate, forward-looking investment in technology.
Oh, okay. Like what?
Well, Bilgi Ishlam ve Yazılım Giderleri, that's IT and software, costs, they rose to 180.3 million lira. And perhaps more significantly, research and development, R&D expenditures, nearly doubled. They jumped from 16.0 million lira to 33.9 million lira.
Okay, R&D nearly doubling is interesting. What does that signal?
This looks like strategic spending. That R&D jump is a key positive indicator, I think. It shows they are actively funding the future infrastructure they need for those fintech arms, GYT, Bilishim, and Fanchain, and almost certainly for building out their new digital assets platform, Mission Crypto.
So they're building the tech foundation for those future bets.
Exactly. Building the necessary competitive moat for the future. So as an investor, you have to try and distinguish between those rising personnel costs, which look like a largely unavoidable burden right now, and these rising R&D costs, which look more like a strategic investment in future growth.
That's a very important distinction. Okay, let's move to the balance sheet. Hashtag tag 60s. Balance sheet health and equity dynamics. Moving over to the balance sheet then, total assets grew, but only modestly, right? From 19.4 billion lira to 20.1 billion lira.
Yes, the overall size didn't change dramatically, but the shifts within the asset composition are quite telling, particularly when you look at liquidity.
What stands out there?
Well, a critical shift seems to be in their liquidity management. Cash and cash equivalents, nakit v nakit benzerleri, actually decreased significantly. They dropped from 5.6 billion lira down to 4.1 billion lira.
Okay, less cash on hand.
But at the same time, trade receivables to Kari Al-Kaklar increased substantially, from 7.76 billion lira up to 9.79 billion lira.
Ah, so less cash sitting idle and more cash tied up in short-term market operations, amounts owed by clients or counterparties.
Precisely. It suggests a group is highly active, using its capital quite aggressively, probably, to fund those massive trading volumes we saw in the government bond section. A lot of activity requires a lot of working capital moving through the system.
Right. And because they're a brokerage, this brings up that critical point about customer credit risk. You mentioned receivables are up. Does that include lending to customers?
Yes, a significant portion. The report details that they allocate 4.07 billion lira in credit to customers, specifically for stock transactions. That's essentially margin lending.
4 billion lira. That sounds like a significant exposure, especially in a potentially volatile market. How well is that risk managed? Does the source material give us any comfort there?
It does provide some important context, thankfully. The credit risk, on paper at least, appears extremely well managed through collateralization. That 4.07 billion lira in customer credit, it's secured by substantial collateral provided by those customers, totaling 17.02 billion lira, according to the report.
Wow, okay, so 4 billion in loans backed by 17 billion in collateral. That sounds like a very robust coverage ratio.
It is, on the surface. A coverage ratio of over 4 to 1 is indeed strong.
But should we, dig a bit deeper? While that 17 billion figure is reassuring, what's the quality and maybe the liquidity of that collateral? Is it all cash and easily sellable blue chip stocks, or could there be less liquid stuff in there?
That is absolutely the right question to ask, and the summary report we have doesn't offer that granular breakdown of the specific types of collateral held. Is it cash, highly liquid stocks, less liquid securities, maybe even other assets? We don't know the mix from this data.
So there's still some residual risk.
There's always residual risk. While the high coverage ratio implies a good degree of safety, you have to remember that in a really rapidly falling market, a true systemic crisis, even highly collateralized positions, can face sudden large margin calls. And liquidating collateral quickly in a panic market can be challenging and might not fetch the expected prices.
So for the purposes of this analysis, we accept the high ratio as mitigating the primary risk, but always with that underlying caveat about market extremes.
Exactly. It's a significant risk mitigator based on the provided numbers, but never a complete guarantee in finance.
Okay, understood. Turning to the other side of the balance sheet liabilities, short-term borrowings have increased.
Yes, they rose from 6.86 billion lira to 7.95 billion lira, which aligns perfectly with that decrease in cash and the increase in receivables we just discussed. They needed more funding.
Where is this short-term funding coming from mainly?
The group is clearly managing a tight liquidity position, actively financing its day-to-day operations. The primary component of this short-term debt is borrowings from the Takas Bank Parapiasasa, the central counterparty clearinghouse's money market. That stood at 5.97 billion lira.
So mostly borrowing from the clearing system's money market.
Yes, this is typically very short-term, often overnight or few-day funding. It's used actively to smooth out those daily liquidity needs that arise from handling massive trading volumes and settlement obligations. They also had about 925 million lira in short-term bank loans.
Okay. And they also issue their own bonds, right? The report mentions those.
They do, and their bond issuances show some interesting risk management thinking. They seem to issue a mix of instruments. About 35% are fixed-rate bonds. The other 65% are floating rate, typically tied to a benchmark like the Turkish lira overnight reference rate, TLREF, plus some margin.
Why the mix? Hedging.
It looks like proactive interest rate hedging, yes. By locking in a portion of their longer-term funding at fixed rates, they protect themselves somewhat if rates soar even higher. But having a chunk of floating rate debt allows them to benefit if, hypothetically, rates were to decrease in the future. It indicates pretty prudent and sophisticated liability management, especially in Turkey's highly uncertain interest rate environment.
Good point. Okay, finally on the balance sheet, let's look at the bottom line there. Equity is Kaynak. How did that fare?
Equity grew robustly. It increased from 4.11 billion lira at the end of 2024 to 4.80 billion lira by September 2025. This growth was supported mainly by that high, albeit volatile, net income we discussed.
And there were some significant capital actions impacting equity during 2025 too, right?
Absolutely. We need to highlight those. They executed a 100% bonus share issue, Biddlesees Sermaye Artırımı. This effectively doubled the nominal paid-in capital on the books from 1.0 billion lira to 2.0 billion lira by transferring reserves.
What's the purpose of a bonus issue like that? What message does it send, especially when they were also doing share buybacks? Seems contradictory almost.
This duality is fascinating. It reveals a really aggressive and maybe sophisticated capital management strategy. Let's break it down.
Okay.
The bonus issue increases the total number of shares outstanding. This makes the price per share lower, all else being equal. Theoretically, this can make the stock seem more accessible or affordable to a wider pool of retail investors, potentially boosting trading liquidity. It also signals confidence from the management. They feel the company's retained earnings are strong enough to support a larger nominal capital base.
Okay, so bonus issue for accessibility and confidence signaling. What about the buybacks?
Simultaneously, they continue their share buyback program, Giri Alenian and Palar. The report notes a total cost of 466.3 million lira for shares bought back, representing about 3.72% of the company's capital. Buybacks do the opposite of a bonus issue in terms of share count. They reduce the total number of shares floating in the market.
Why do that at the same time?
Buybacks are typically done to support the stock price. By reducing the supply of shares, they can potentially boost earnings per share, EPS, for the remaining shares. It also signals that management believes the company's stock is currently undervalued by the market.
So they're trying to make the stock look accessible to the masses with the bonus issue, while also actively supporting the price and signaling undervaluation to existing shareholders through the buybacks.
Exactly. It's like trying to have your cake and eat it too, from a capital markets perspective. It's an optimized play aimed at influencing market perception and maximizing perceived shareholder value from multiple angles. Quite dynamic.
Very interesting strategy. Okay, let's move on to the cash flow statement. #TechSF cash flow analysis, the operational reality.
Right. If the income statement presented us with that paradox of high revenue but lower core profit, the cash flow statement should, in theory, strip away all the accounting noise, like the inflation adjustments and mark-to-market gains, and show us the fundamental operational reality in terms of actual cash movement.
And we need to look very closely here at the operating cash flow, the CFO, because this is perhaps the most critical section for understanding the real health and sustainability.
Absolutely critical. And operating cash flow experienced a truly dramatic and frankly worrying reversal this period.
What were the numbers?
Last year, for the first 9 months of 2024, their CFO was positive 2.67 billion lira. They generated cash from operations.
Okay.
This year, for the 9 months ending September 2025, it plunged to a negative 1.59 billion lira.
Negative? Wow, that's a swing of over 4 billion lira from positive to negative.
It's massive, and this is the definitive signal. Despite reporting that huge net profit on paper of 1.22 billion lira, the group actually used 1.59 billion lira of cash in its core day-to-day operations.
So a negative CFO means the cash coming in from sales, commission, services was simply insufficient to cover their operational needs and the changes happening in their working capital.
Exactly. The paper profits are real, according to accounting rules, but the actual cash generated wasn't enough. The cash got absorbed somewhere within the operating cycle.
Where did the money go then? If profit was positive, why was cash flow negative?
It was absorbed primarily by those big changes in working capital, largely related to their massive trading activities. Specifically, remember that sharp increase in trade receivables we saw on the balance sheet. That tied up cash,
Right, nearly 2 billion lira increase there.
and also facilitating that 216.9 billion lira in government bond sales. That requires having trading assets on hand or financing those positions. They essentially had to put up a lot more cash to support that enormous volume and the accompanying trade credit extended or margin lending provided. The business grew so fast in volume terms that it consumed its own operational liquidity.
Okay, so the high volume, low margin business was cash hungry.
Very cash hungry. This operational cash deficit then forced them to rely entirely on external funding to plug the gap and also fund their strategic plans. Which brings us to the next section, investing cash flow, or CFI.
And how did that look?
That was also negative, showing a net outflow of 381.8 million lira.
So they spent cash on investments too. Is this good or bad?
Well, this negative CFI is actually intentional and confirms that aggressive strategic focus we talked about earlier. This isn't cash disappearing unexpectedly. It's cash being actively spent on building future growth, not sitting idle.
Where did the investment cash go specifically?
The largest outflows noted were 264.7 million lira for capital increases in their associates and subsidiaries. That's funding going into Mission Yathanam Bankasha, Inveo Ventures GSYO, and almost certainly the setup and capitalization of the Mission crypto platform.
So feeding those strategic bets.
Precisely. Plus, another 118.4 million lira was spent on tangible and intangible assets, things like computers, software, office upgrades, confirming that necessary investment in technology and physical infrastructure.
Okay, so let's recap. High reported net profit on the income statement. Negative operating cash flow, meaning core ops burned cash. And negative investing cash flow, meaning they spent more cash on strategic long-term assets. They were bleeding cash operationally and intentionally spending cash strategically. How did they possibly finance all of this? Where did the money come from to cover the operational hole and pay for the investments?
That brings us to the third and final piece of the cash flow puzzle, financing cash flow, or CFF. And this was strongly positive, showing a net inflow of 1.49 billion lira.
Ah, so this is the inflow that bridged those massive gaps from negative CFO and negative CFI.
Exactly, it had to. And it was dominated by net borrowing activities. The report shows a 2.25 billion lira net inflow from borrowings. That's mostly from increases in that short-term debt, like the Takas Bank money market borrowings we discussed, and also proceeds from new bond issuances they did.
Okay, so they borrowed 2.25 billion net.
Right. And from that inflow, they paid out 537.5 million lira in dividends to shareholders. So the net positive CFF of 1.49 billion essentially covered the 1.59 billion operational deficit and the 381 million investment spending, with some rounding differences.
Okay, this is where we need to apply some critical analysis, isn't it? They are heavily relying on financing activities, primarily short-term borrowings, like from the Takas Bank money market, not just to manage daily liquidity, but essentially to fund long-term, potentially illiquid, high-risk strategic investments, like the capital injections into the VC fund and the new crypto platform. What kind of systemic risk does this potential mismatch introduce?
That's the key risk to highlight here.
Mm-hmm.
Duration mismatch and liquidity risk. Short-term debt, like money market borrowing, is usually cheap and flexible, which is attractive.
Yeah.
But it has to be rolled over constantly, daily, weekly. If there's a sudden liquidity crunch in the wider market, maybe triggered by some external event, or if short-term interest rates soar unexpectedly, making rollover prohibitively expensive, they could suddenly struggle to refinance that, nearly 6 billion lira in Takas Bank borrowings. Funding inherently illiquid long-term assets like VC stakes or a nascent crypto platform with highly volatile short-term debt is structurally risky.
It shows management is confident, certainly, willing to use leverage quite aggressively, and probably highly sensitive to the prevailing cost of short-term money.
Absolutely. It's an aggressive growth strategy, no doubt about it, and it relies heavily on their continued ability to access those wholesale money markets smoothly and affordably. Any disruption there could cause significant problems given this funding structure.
A key risk factor to monitor. Okay, let's look at some of the critical disclosures, #8, critical disclosures and future outlook.
Yes, we need to definitely reiterate the broader regulatory and accounting context here, starting again with the impact of that inflation accounting. The mandatory application of TMS 29, just to remind everyone, stems from the fact that cumulative 3-year inflation in Turkey had reached a staggering 222% as of September 2025. That officially places the Turkish economy in a hyperinflationary environment for financial reporting purposes.
Right. And we saw the sheer power of this standard when we analyzed that net monetary loss figure, the 573.3 million lira loss in 2025, and how its smaller size relative to the 1.19 billion lira loss in 2024 created that massive over 600 million lira uplift in the reported net income purely from the accounting treatment changing less negatively.
Precisely. And the key takeaway here for you, the investor, is the inherent volatility this introduces to the bottom line. You have to be aware that the final reported profit number for any company reporting under TMS 29 is potentially unstable because it's heavily influenced by these non-cash, non-commercial accounting adjustments.
So, a slight change in the official inflation index used, or even just a change in the company's own mix of monetary assets versus liabilities, could dramatically alter the reported net profit, regardless of how well their core brokerage business actually performed in that period.
Exactly. It adds a layer of accounting-driven volatility on top of the already volatile business operations.
Okay. Let's also touch upon the ecosystem they operate within, those related party dynamics, particularly within the controlling Inveo holding structure. The report confirms a lot of transactions there, right?
Yes. Note 19 in the full report likely details this extensively. The summary confirms a very high degree of vertical integration. Transactions are mentioned with numerous related parties under the Inveo umbrella. Inveo Portfolio Nitmi, Portfolio Management, Inveo Ventures, the VC arm, even companies like Inveo Oras Kirolama, vehicle leasing.
What are the implications of such strong integration?
Well, on the one hand, this integration can offer powerful efficiencies. They can keep business in-house, cross-sell services, potentially reduce costs. But on the other hand, it requires rigorous transparency and strong corporate governance to ensure that all these transactions,
Like the buying and selling of related party investment funds and bonds, which totaled a significant 921.3 million lira, according to the notes.
exactly like those. To ensure those transactions are conducted truly at arm's length on fair commercial terms and not structured primarily to benefit one part of the group over another or over external shareholders. It's something regulators and minority investors always watch closely in highly integrated groups.
Makes sense. Finally, risk and contingency. The operational risk they're taking on seems reflected in their contingent liabilities, particularly guarantees given.
Yes, this is important. The total guarantees and collateral they provide, primarily to essential market infrastructure, bodies like Takis Bank, the clearinghouse, and BST, the stock exchange, increased substantially. It went up from 979.1 million lira at the end of 2024 to 1.67 billion lira by September 2025.
That's nearly doubled. What does that increase signify?
It directly highlights the increased operational risk appetite, or perhaps just the increased operational requirement needed to handle those massive trading volumes, especially in the fixed income market that dominated their revenue. More volume going through the clearing system simply requires more guarantees and collateral to be posted as a safety measure.
So it's a necessary cost of doing business at that vastly increased scale?
Largely, yes. It reflects the scale of their market activity. Crucially, however, alongside this increased risk exposure, the group confirms in the report that it continues to meet all the required capital adequacy ratios stipulated by the regulator, the SPK, specifically referencing Series V number 34.
Meaning their underlying capital base, their cushion against losses, remains resilient and compliant with regulations, even with the increased risk they're managing.
Correct. According to their filings in these statements, they remain adequately capitalized under the regulatory framework.
Okay, that provides some important context on risk management. Let's try and bring this all together. #tag IX. Conclusion and final thought. Okay, let's try to synthesize this massive deep dive into Gedik Yatırım's first 9 months of 2025. It really feels like we uncovered a story of rapid, almost aggressive strategic transformation, heavily dictated by this challenging, high inflation, high rate macro environment in Turkey.
Absolutely. The picture that emerges is definitely one of paradox. On one hand, Gedik achieved this phenomenal top-line revenue growth, truly explosive numbers. But we saw that was overwhelmingly driven by very low margin, extremely high volume government bond trading, likely a side effect or perhaps an opportunistic play on Turkey's current macro climate.
Right, and that massive volume, it actually masked a worrying dip in their critical core operating performance. We saw that İsas Faaliyet Kara figure decline, and the traditional brokerage commission income also fell quite sharply. That signals real competitive pressure on their core traditional business machine.
Exactly. Yet, despite that core pressure, their bottom line net profit was aggressively boosted. But not by operations. It was lifted by factors external to the day-to-day brokerage business. Very high financial income, thanks to high interest rates and good treasury management, strong gains from their strategic investment portfolio, and critically, a significantly less severe hit from the mandatory inflation accounting adjustments compared to the previous year.
So for you, the investor trying to make sense of this, the nuance is absolutely vital, isn't it?
It's everything. Gedik Yatırım is clearly, actively executing a robust, definitely future-focused diversification strategy. They are sinking real capital, actual cash, into these potentially high growth but also high risk areas like regulated crypto trading, venture capital through Turpay, and the underlying fintech infrastructure. We saw that clearly in the negative investing cash flow.
And they're funding this ambition, plus plugging the hole in their operational cash flow by leveraging themselves quite heavily, particularly through short-term debt and bond issuances. We saw that in the positive financing cash flow.
Right. So the quality of their current reported profitability is, let's say, volatile and maybe lower than the headline numbers suggest because it relies so heavily on that financial income and those accounting dynamics. While their capital base remains compliant, according to the reports, that funding structure using potentially volatile short-term money to back long-term, illiquid strategic bets demands really careful ongoing scrutiny from investors.
Which brings us nicely to our final provocative thought for you, the listener, to perhaps mull over as you analyze not just Gedik, but maybe other players in the sector too.
Given Gedik Yatırım's aggressive, clearly cash-hungry investments in these high-risk, potentially high-reward ventures, Mission Crypto, Turpay GSYO, the fintech subsidiaries, the crucial question for their future isn't just if these ventures will eventually succeed and become profitable on paper. It's how quickly can those potentially valuable, but currently cash-consuming, high-risk investments translate from maybe just paper equity valuations on the balance sheet into sustained high-quality operating cash flow. Cash flow that's strong enough to support the overall balance sheet and reduce that reliance on constantly rolling over new, potentially volatile short-term debt just to cover the ongoing operational and investment needs.
In essence, can the future they're building start funding the present before the present funding structure becomes too strained?
That's the essential challenge, isn't it? Balancing today's operational realities and funding constraints with tomorrow's ambitious, cash-intensive bets, especially for high-growth financial institutions operating in such volatile markets.
It really is.
Well, thank you for joining us on the Deep Dive today. We sincerely hope this detailed analysis provides you with some valuable clarity as you navigate these complex financial reports.
Indeed. Until next time, stay curious, keep digging into the numbers, and always, always challenge the source of the operating profit.